Welcome to the True Wealth Podcast, where we specialize in helping aspiring homeowners break into the real estate market and help investors create and build wealth through real estate. We will be sharing some of our best advice around real estate so you can purchase your first home or grow your real estate portfolio, increase profitability, reduce taxes, and achieve financial freedom. Your host, Sean Adeyemi, is a certified financial planner, mortgage professional, and fellow investor. We want to help you get real so you can pursue your investing dreams with confidence. A real estate acquisition lifestyle is within your grasp. Financial freedom is possible when you have the right mindset, coaching, advice, and community. So, let's get real.
I'm your host, Sean Adeyemi, and today I have got my co-host with me, Othniel Lichmore. Othniel, how are you doing today?
I'm good, man. I'm blessed and highly favored. That's what
I love that. So today we want to talk about mortgages. And Othniel, you had a client scenario you were painting to me about a client's. Can you tell us a little more about that, and we can kind of unpack it together?
Absolutely. So I had a client. I sent them to a broker that I knew. And there's a broker, after doing an analysis, a mortgage broker, after doing an analysis of the client's financial situation, they proposed that the client go with an alternative lender, a B lender. Obviously, that came with a higher interest rate, somewhere in the mark of 6%. So the client was like, okay, they were probably going to go with that. But then they walked into their local TD branch and just had a surface conversation with the mortgage specialist in-house. And that person said, hey, TD is offering fixed rate mortgages in the high 4%. So 4.7, 4.8. So then my client came back to me, is like, hey, how come the broker is saying that I have to take a 6% mortgage when TD is saying I can get a mortgage in the high 4s?
Now, like rates,
yeah. TD didn't do any sort of financial analysis and sort of nor did they look into their situation, my client's situation. So maybe, Sean, you can sort of explain from the broker's perspective, what may have happened here. Why is it that the broker felt that an alternative lender would have been appropriate in this situation? And, are people being tricked? Are they being forced to go to alternative lenders because there's a higher interest rate or whatever? Maybe there's some fees and stuff, when they could have easily gone to your TDs and your RBCs or stuff like that. Maybe you could speak to that a little bit.
Well, here's the thing. The average broker who is worth their grain in salt and knows what they're doing will always try to get their client the best rate possible. And so for the most part, we would always look at the prime rate lenders. So we'll look at all the major banks. We'll look at some of the other lenders in the private space before we recommend an alternative lender to a client. Now, a few things that usually go into determine whether a client should go to a prime rate mortgage or an alternative mortgage is really just mostly their income and their debt to income ratio. So brokers, when we are analyzing a file, we're looking at, if we're going to get you on a prime rate, we're looking at a ratio of 39-44, which means that the mortgage you're applying for, in addition to whatever other debt you carry, in addition to whatever other cost that buying that house will bring, the ratios have to fall within a certain line. And so once we pull your credit and we analyze those numbers, if those numbers are outside the ratios of a prime lender like the bank, then we'll look at the B lender or we'll look at the alternative lender.
So are you saying the prime lenders are more strict, more?
That's correct.
Okay.
That's correct.
Okay.
Correct. Prime lenders are stricter in the ratios they will allow for files that they receive. Not even just that. Depending on how much the client is putting for down payments, right? If the client is putting less than 20% down, then it's most likely going to be an insured mortgage. So because there's an insured mortgage, there's an insurer coming to back that mortgage. And the insurers also put their own criteria for which they will insure a mortgage. So sometimes a bank can say, if you're putting less than 20%, a bank can say, we're willing to do this file, but we need to get approval that the insurer will back this file. So usually that's where the buck stops. If the insurer says they're not doing this file, then the lender will most likely say, we can't do it either unless the client is doing 20% down. When the client is doing at least 20% down, it opens up options of where they can put their funds. And for this scenario here, for the broker to move them to an alternative lender, I'm going to assume that they were putting at least 20% down, because that's the other part of it is when you're doing an alternative mortgage, you generally have to put at least 20% down. And so the criteria it first starts with, does the client have a prime score? Does the client have, usually you need at least a 600 score, but even then lenders are, to be more competitive, you're looking at 680 plus credit score. Right? Yeah. And so there is a chance that the broker already analyzed all of this, looked at the numbers, and then advised the client, I think an alternative lender will be best for you. But obviously when the client walks into the bank's going to tell you, yes, we can do this with a periphery analysis without actually pulling the credit and looking at the tax statements, because that's the other part of it. When a prime lender like a bank is looking at your file, they're using your tax statements. They're looking at what you declared on your income. They're looking at the job you have. For instance, if you've been working at a job for less than 2 years, they want to see, okay, what were you doing before that? They want to see your T4s and your notice of assessments for the last 2 years.
They're more
right?
inclusive, like in order to get that better rate.
Exactly.
Yeah. Okay. And do you think like it's justified? Do you think, because I've always had an issue with this, all this digging, are they getting the information that they're looking for, or is it just like sort of like a way to say they did their due diligence? Like, do you think there's the useful information in what they're digging for?
There is, because each lender has to weigh their risk. Okay, what's the risk profile for this borrower that we're going to lend money to? And different lenders have different risk appetite. And so if you have someone who's been in a job for just 6 months or a year, they're technically a bigger risk than someone who has been at the same job for 5 years. There's a bit of job stability in that. And so prime lenders want to know that, okay, what you say you're making is also what you're telling the government, because very few people actually lie to the government or the CRA on how much they're making. I'm not saying people don't lie, but nobody wants to pay more taxes than they ought to pay, right? So if I see I'm making $100,000, then I'm making $100,000. That's what I'm telling CRA, and then CRA wants to see, and then the lender wants to see that, okay, if I'm making $100,000, that's what not only what my job letter says, but that's also what my CRA documents say. So prime lenders usually dig for more information, because the more information they get, the more they're able to analyze what's the risk profile of this borrower and what's my risk involved in lending this client the funds to do it. Insurers also have their own additional risk that they have to mitigate. And that's why when you're trying to get a prime rate, they're asking for everything. They're asking for your firstborn sons. Because
we ate for breakfast.
Exactly, right? They want to make sure that this is a qualified borrower. On the alternative side, there's a little more wiggle room. One, the ratios are expanded. So even if you fall outside of the guidelines, you may still be able to get a mortgage. Obviously, you're putting more down, but they're not asking for an arm and a leg. Many alternative lenders will still ask for your CRA documents, not to verify income, but more to ensure that you're not owing CRA money, because nobody wants to, at least on the alternative or prime side, nobody wants to lend mortgage to someone who's owing CRA money. The reason why is when CRA comes to collect, CRA always comes before everybody else, right? So if you're owing me mortgage and you're owing CRA debt, the CRA debt is going to come first. The government doesn't care about your mortgage or everything else you owe. They care about the money you owe them. And so alternative lenders will look for ask for your tax statements, your tax documents, to ensure you don't owe. Now, there are other things they look at. They look at your ability to borrow. They look at the type of property you're buying. They look at your credit score. For instance, on the prime side, you're only allowed to have maybe 1 or 2 derogatories. So maybe you missed one credit or payment, you missed one credit card payment. On the A side, if you have one, they may still be able to work with it. If you have more than two, many A lenders will not want to look at you because they see that as credit worthiness. If you've missed payments on this credit cards or on this loan payments, how trustworthy are you that you're not going to miss payments on your mortgage, right? On the alternative side, they're a bit more lenient with that. They want an explanation. So what happened? And they even, on the alternative side, you can even get a mortgage as low as 550, sometimes even 500 credit score, right? Because they understand life happens. They understand divorces, bruised credit situation, you borrow somebody money. And so usually for us brokers, the goal is to present our clients in a way that the lender will be comfortable with the story and what's happened to this file and why this client does not have the greatest credit file. On the A side, there are no stories, very rarely, right? They just want pristine credit score. They want pristine tax, income qualification. They want those things to be very clear so there are no gray areas. On the alternative side, there's a bit more wiggle room as to what happened to you. So there's a chance that, going back to your original question, the broker already assessed all of that, looked at their credit score, looked at their income, and looked and say, well, the ratios are a bit out of line. And so maybe the B side or the alternative side is better for you. Or maybe you've had 2-3 missed payments. The bank would not accept this file, right? Walking to the bank, they'll always tell you they can do it, right? They'll say, yes, we can do it. But I found many files come to my desk a week before closing because the client, first of all, they call me and say, we want this mortgage, and I give them what their options are, and I never hear from them. Dead silence. And then this is probably because they went to the bank, and the bank said, we can get you a better rates or whatever the case is. And then a week later, they come back to me, my mortgage is closing, I need. So I'm like, what happened? You came to me 6 weeks ago. Well, the TD said, or the bank said they can give me this, but now they're saying they may not be able to, because what's happened is the bank has done their due diligence and they found what we found at the beginning, right? They found what we found and now they're saying no, right? So I get a lot of files like that where the bank has said no 3 days before closing because they found out something, or they found one of the things I find that sometimes files almost fall apart is down payments. Not because they don't have the down payments, but the down payment is coming from all different sources. And the lender says, where's this money? I can't trace the source of these funds because of the anti-money laundering rules, right? We need 90-day history on where this money has been coming from, where this money is coming from. So if you've had international transfers from other countries and from where you can't really the lender is not comfortable with where's this money coming from, they can tell you, we'll give you this file, we'll give you this mortgage, and a week prior to closing, they look at all this document and like, this file is a little too risky for us, right? And then the alternative side comes in. So that's one thing that I always tell clients to be very wary of. Take a look at, if the bank is telling you they're going to give you an offer, let them send it in writing. Let them send you a commitment, because the commitment will show what are the conditions that need to be fulfilled for them to give you this mortgage. They can promise to give you this mortgage, but that promise is conditional. It's conditional on meeting all the different criteria they have on their list, right? So before we submit a file to a lender, we make sure we collect all the documents. We already know what they're going to ask us for. And so sometimes when we're asking for information, the borrower many clients like, oh, why do you need all this? Why do you need all? Because I know the lender is going to ask me for it. Because I know that I don't want a situation where a few hours or a few days prior to closing, I still don't have this paperwork. And now it makes me look bad as a borrower as the broker, because you haven't submitted the information that I need. So most brokers will review all the information to make sure that this is the best mortgage for you before putting you in it, before recommending something. Now, there's also a little bit of experience that comes with this, right? Someone who has done 300 files, 1,000 files has more experience than someone who's done 10 files.
That's fair.
Or who's done even 200 files, because we see most of the same things all the time. And we're able to, sometimes the relationships we build with the lenders, they understand that when files come to them from this broker is most likely a good file. And so they're able to sometimes even offer us rate discounts because we've done a lot of work with them. They know that whoever we're qualifying for a mortgage, we've done our due diligence. Now, they'll still do their due diligence, but once again, sometimes it takes being creative as a mortgage broker to find the right mortgage for clients.
That's true.
Now, you mentioned something before we got on the call about private mortgages.
Right. That was going to be my next thing. Because, all right, so a lot of people don't realize, like, it's almost like 3 tiers of mortgages. You got your A prime lenders and your TD, RBCs, your Scotias. You got your B lenders with, credit unions and stuff like that. And then you have your private mortgages. And I think a lot of people, if they feel like if they're not getting something from TD or Scotia, a mortgage from TD or Scotia, that they're ending up with a private mortgage. And like and things get crazy with private mortgages. So maybe you could talk a little bit about private mortgages, how they work, and why, sometimes people find themselves in trouble with private mortgages. Because I've seen a few power sales homes come across on the market, and it's usually like a private lender that has, moved to power sale to sell the property. So maybe talk a little bit about that and why people find themselves in trouble with private mortgages.
Well, most people that go to private mortgages usually do that as a last resort. Like they've gone to their bank and their bank says no, but they've already put an offer on this property, and sometimes they don't meet the right broker or the right agent to help them work through the file, not knowing that just because it's not a prime rate doesn't mean it has to be a private. There's the alternative space that falls right before the private. So sometimes when people end up in private, it's because they haven't had the right advice. And sometimes they may have had the right advice, but their financial circumstances do not qualify them for either a prime rate mortgage or an alternative mortgage, and private is where they're left with. With private mortgages, I would generally take a look at the commitment they send you because they can have some pretty hefty fees that they include, because on a private mortgage, you're paying your legal fees and you're paying the legal fees for the lender. You're paying broker fees, you're also paying lender fees. And then if there's any missed payments, private mortgages are not as lenient. If you miss one payment, if you miss 2 payments, they can move to a power sale much quicker than an alternative or prime lender can. And so when people are ending up in private mortgages with power sale, it's because, let's face it, there are some private lenders that out there that are shysters. They are preying on people because they want to take over the homes. And that's why private mortgages generally offer a higher down payment. So they will tell you, we'll give you a loan, but you need to put at least 25% down. You need to put at least 30% down, because they know that if they sell this property, even after they factor in your down payment, they'll still walk away with a profit.
Wow.
Right? And so private mortgages can be good because I have clients who own multiple properties, and then the more properties you own, you may end up that the only mortgages you're not qualified for are private mortgages because you've exhausted your income to debt ratios. Private mortgages don't look at the income to debt ratio. They just look at the ability to service that mortgage. So they look at the rental income you're potentially going to receive on that property. They look at the loan to value. Sometimes that's really all they look at. They look at the loan to value. Is there enough equity in that property to secure my investments as a private lender? And so you want to look at, for anyone looking at private mortgage, you want to look at all the conditions and all the clauses they have on that offer, because you miss a payment, it's $500 plus your missed payments. You want to pay out this mortgage, is $1,000 plus a $300 discharge fee. And so you can end up with a private mortgage that can end up at, let's say, started at $380,000. By the time you add this fee and this fee and this fee, you end up paying $400,000 off just to pay off that private mortgage. So I'm not saying private mortgages are bad. I'm just saying that you have to scrutinize whoever is giving you that offer and look at the conditions that they are offering you on that private mortgage. And also make sure you explore the alternative space before going into the private space. That's usually what I would recommend. I've done private mortgages. I do them regularly. They don't make up, maybe they probably make up 20% of my book or even 15%. I don't do a lot of it. I find most of my clients are either in the prime rate space or the alternative space. And that's where we try to put the clients. As broker, the goal is to get them the best rate possible. And if they don't qualify, we'll move to the next best rate possible before we finally, if there are no other options, then we'll look at private mortgages.
No, that's very helpful. Like I said, I think a lot of people are confused about like the different mortgage options that are available to them. And you sort of need some qualifications, because you can't help but think, if you're not going to one of the top 5 banks, that you're being taken advantage of. And so like, it would be like you got to be extra vigilant. But the reality of the situation is that there's just different qualification criteria. And so some are more lenient. And if it's more lenient, then, and because all our situations are different, right? I always got the sense that the banks, the top 5 banks, they just want people with regular jobs, regular income, regular credit score, you know what I mean? Just in a neat package, right? But a lot of people have side hustles. A lot of people are self-employed. A lot of people, have different sort of income arrangements. And the big banks typically don't look at that in the best light. They just want you to be regularly employed, 9 to 5, paycheck every 2 weeks kind of situation. So that's why these alternative lenders exist. I mean, obviously you have to pay a higher interest rate and some other fees as well, but it does get you into home ownership where in other instances you might not qualify. So I'll
add that even before looking at the non-5 big banks, even before going to alternative space, there are lenders that are prime rate lenders. They're non-banks, they're credit unions, they're financial institutions that will offer you similar rates to what a bank will offer you, right? In Canada, there's probably about 20 plus prime rate lenders that are non-banks. So we're not talking TD, RBC, CIBC, Scotia, what's the 5th one? BMO, right? There's National Bank, there's Manulife, there's First National, there's a lot of other prime lenders that will offer you rates very similar to the bank, but are not as strict with the bank. And one of the things most people don't even realize and they don't explore is that your bank, the 5 main banks are usually not even the best route to go when it comes to your mortgage. And the reason why is because of something called the IRD calculation. So very few borrowers actually carry their mortgage to full term. People usually either have to refinance. So you have a 5-year mortgage, you will have to refinance 3 years later, or they have to sell for whatever reason. The 5 big banks have what they call a high IRD calculation. We're not going to get into this podcast because it'll probably take another 25 minutes to go through it. But the basic idea is if you need to refinance, they charge higher penalties, right, than the non-bank lenders. And so I always say rate is one thing to look at, but it's not the only thing when you're getting a mortgage. You want to look at portability. You want to look at IRD, which is interest rate differential. If I need to refinance my property, if I need to sell my property, which one is going to charge me a lesser penalty to qualify for the new mortgage or to refinance my property? So those are some of the things I always look at. Is before you even get to the alternative space, if you looked at the 5 big banks, there are other lenders. There are other lenders to explore, and that's where the value of a mortgage broker comes in.
Yeah, no, I think valuable advice there for people, looking at different mortgage options. A lot of people I know, they just go into their bank, talk to the advisor there, and that's all they know about mortgages. So I think this conversation was very helpful in the sense of letting people know what their options are.
Yeah, absolutely. Feel free to reach out to us if you need help figuring out what's the best mortgage for you. We'll do that free of charge. And at the end of the day, the goal is to help you find the best option for you that suits your family. And that's where the value of what we do is I'm not simply a mortgage broker. I'm a certified financial planner. Yeah. So I'm looking at the numbers. I'm looking at, does this make sense for you in the long term and in the short term? So I hope this is helpful for you. Also, thanks for bringing up this question. I think it's a question many borrowers or those looking to get into homeownership always have. but don't quite know how to ask or who to ask. So I hope this was helpful.
Awesome.
You've been listening to the True Wealth Podcast. I hope this conversation was helpful for you. If you want to learn more, check out our page. It's been a pleasure having you, Othniel. Thank you very much.
Thank you.
This is all the time we have for today. Thanks for listening to the True Wealth Podcast. Don't forget to rate, share, and subscribe to the True Wealth Podcast on your favorite podcast platform. Follow us on Instagram, Twitter, or Facebook at True Wealth Pod. We'd love to hear from you. Share your thoughts, ideas, and questions with us on our social media platforms or email us at podcast@truewealthadvisors.ca. And who knows, your question might be the subject of a future episode.